Welcome, everyone. Excited to be here. My name is David Easthope. I am the head of FinTech at Coalition Greenwich, and I'm very excited to have all of you here. I see we already have a lot of attendees and listeners, which is fantastic. We're here for a deep and detailed discussion on tokenization for trading and clearing. Today, we'll be highlighting some Coalition Greenwich research. We'll be discussing current activities. We'll be discussing the future state of blockchain and tokenization with a really great and esteemed panel with a tremendous amount of both crypto as well as traditional finance backgrounds and experience. And so we're very excited to jump into that. First, a couple of housekeeping items for today. We are recording this webinar, and we will make the recording available after the event in the coming days. So please keep your eyes out for that. We'll be spending around 40 minutes or so on this discussion. We will have time for some questions at the end, so please go ahead and put your questions in the chat, and we will do our best to get to them again at the end. Before we dig in, I'm excited to let the panelists briefly introduce themselves. We have a great panel today. We're going to have a great discussion. So, Kelly, why don't you introduce yourself first, and then we'll go to the rest of the panelists.
Great. Thank you so much. And good morning, everyone. Delighted to be here. Kelly Matheson. I lead business development at Digital Asset, where I've been for a number of years. Come from the capital market space, though, and delighted to talk about this topic today.
Hey everyone, my name is Glenn Barber. Very nice to be a part of this. David, thank you very much for the invitation. I also have a traditional financial background, having grown up in the equity markets for banks like Lehman Brothers, Deutsche, and Barclays. Have been in digital assets for 7 years now, and am the head of business development for the Canton Network at DRW.
Hi, everyone. Chris Bruner from TradeWeb here, Chief Product Officer at TradeWeb. Been with the firm a little over a decade now. Also come from the traditional trading background in FX markets, derivatives, and credit trading, in a wide variety of fixed income. So really excited to be here today.
Yeah, hi, everyone. My name is Stephen Brule. I cover derivatives and FX for Coalition Greenwich. I have the privilege of leading off this discussion. I've been in and around collateral, as a matter of fact, since before the Lehman bankruptcy. But don't worry, I'm not going to spend too much time in the past. We're not going to regale everybody with stories about how things used to be, because this webinar is much more about what we think the future is. But in my mind, what we've seen over the course of the past decades have been huge amounts of very positive change in workflows and how people think about collateral, and the strategic importance of collateral relative to maybe where it was, 10, 15 years ago. Concurrent with that, we've also seen a huge increase in the complexity of the collateral ecosystem. We've seen regulations ranging from UMR to Basel to FR, like all of these different regulations around capital and balance sheet and credit. They make the need to think about collateral more strategically. They increase that need dramatically. So though we've seen a lot of great progress, we've also seen an increase in the challenges that are out there. So what kind of challenges am I talking about, right? We all understand the importance of collateral in terms of like a risk management function, but if it's not properly optimized, it does affect the economics of the business that you're trying to run. So we all understand that we really need to think about this and how do you optimize the process, because there are costs associated with collateral. There are operational costs, there are funding costs, all of those are going to tie into the need to think differently about how the collateral management industry needs to evolve, right? Because if we think about where we are today, derivatives are a global asset class. You're going to have collateral across multiple time zones, multiple jurisdictions with multiple custodians, multiple CSDs, multiple ICSDs. Can you move the best collateral for a particular obligation from account A to account B easily? Sometimes yes, oftentimes no, right? So then what we need as an industry, what I think we need to start to think about is how we can start to affect some of those changes in order to make the process more efficient. Because by the way, we're not done with market structure changes. 24/7 trading could have a big impact on collateral. So as we get through Dodd-Frank, EMIR, UMR, we say, okay, now we can rest. Well, no, we can't, right? Because we keep seeing the evolution of the market structure demand faster movements of collateral and more efficient use of collateral. And so part of what I did earlier this year, I conducted some research into the derivatives industry, sort of writ large, across a variety of topics. And this topic is certainly one that we wanted to talk about. So I'm going to share some data for everybody to take a look at. We asked the question, which of the following will be the greatest game changer for the trading and clearing workflow? So as you can see, we had 249 responses to the survey, and that's across sell side, buy side, exchanges, CEFs. We even had a couple of industry lawyers in there as well. So it's a pretty large population to get to 249, excuse me. Gen AI came in at 1. Tokenization of collateral came in as the second most important, or the second highest potential to be a game changer in the industry. So what's interesting about this, I asked the same question in 2024. In 2024, what you see second from the bottom, the development and adoption of operational standards, that came in first. So what's interesting is to see how much we've seen a shift. And I think that as we've seen use cases in AI, use cases in tokenization bear fruit, people are now starting to think more about, okay, we're leaving theoretical. We've seen pilots, we've seen the progress, we've seen the ability to create change from using these new methodologies. And that's why we're starting to see such a shift in the importance of tokenization relative to things like global standards over time. Not to say that operational standards aren't important, they are, but nonetheless, we're also seeing people get excited about some of the new potential here. And so I wanted to sort of dive a little bit deeper into these numbers. I wanted to just look at the sell side, executing brokers, clearing brokers, that population. We had 106 of those respond, and the majority said, or tokenization came in at number 1 for the sell side. So if you think about a large global universal bank and the totality of collateral obligations they're going to have across their entire book of business, across the entire globe, it is very, very complicated. Not that it's not complicated for an asset manager that's got unitized funds, but it's just a different sort of kettle of fish, as it were. And so for the sell side, they have tokenization as the highest potential to be a game changer relative to any of the others. So I thought that was interesting to see that where we saw the value that the sell side saw in it, maybe a little bit higher than some of those other market participants that I talked about. So all this says to me, and the reason I didn't want to sort of live in the past in my introductory comments, or because these two data points tell me that the market participants are really want to understand what the future of collateral is. Where's it going to be in 3 to 5 years? I think the good news is we've got the perfect set of panelists to sort of go through that and talk about what they've been doing and how they want to affect collateral and how they want to change the collateral ecosystem over the coming years.
Thank you, Stephen. As an excellent summary of the changing landscape. And before we get into the panelists' views, because I know we're going to dive really deep in this topic, just wanted to further expand on the Coalition Greenwich view here, because there's a lot of chatter about tokenization, stable coins, tokenizing funds, and I think increasingly there's a focus on high quality liquid assets and what that will entail for the movement of those assets on chain. In particular, the tokenization of treasuries has this potential to really revolutionize repo trading and collateral management. So the ability to move those treasuries on chain along with the cash equivalents, again, emphasizing that, allows for these transactions to settle in minutes and unwind in hours versus overnight and weekends. And I know Canton and Glenn and Digital Asset Tradeweb will get into the mechanics of this because, as you said, Stephen, it's about moving from pilots into production. And this is a real live production environment that's or situation that's emerged. And just to continue on that view before I hop over to Glenn for a second, the tokenization of and movements of these assets will allow for a lot of greater speed as well as efficiency. And I think, Stephen, you mentioned the collateral management operations, improvements in the market structure. We think that all these things have huge potential, and we hope this conversation will educate, will inspire, and will allow folks to sort of jump off and do some of their own research, participate in tests, trials, and seek out other use cases within the tokenization world. Because if you just look at the number of brands and participants on the most recent transaction, which took place on Canton, there's a lot of really fantastic names there associated with that. and this transaction, which Glenn, I think you're perfectly positioned to explain exactly what happened. Maybe summarize the role of the participants, what were some of the main benefits, and what does it mean when collateral movement actually moves on chain. So let me hand this to you, Glenn, just to sort of summarize the recent events.
Sure. Thank you, David. I think what the participants would like to know is that on a Saturday in late July of this year, right, a number of market participants got together with the benefit of blockchain technology and did a 15-minute intraday repurchase agreement on a Saturday with no banks open, no traditional exchanges open, and did so using the benefit of blockchain technology on the Canton network. So, like any repurchase agreement, one firm had cash to lend out, another firm had a need to borrow and had collateral to post. And I'm going to oversimplify a little bit here, but through software and technology delivered on the Canton network by Digital Asset, through the trade arranging software delivered by Tradeweb, a number of trading firms, prime brokers, and even a centralized clearing organization like DTC participated in this trade where the firm with the desire to borrow through the use of software was allowed to tokenize a US Treasury as collateral, taking this real world asset and putting it in tokenized form in literally a second or two. Correspondingly, a firm with the ability to lend had cash on their balance sheet, usually in US dollars. In the same way, they were able to use their mouse, click a couple of buttons, tokenize their cash into a cash equivalent such as USDC, the stable coin provided by Circle, and then use Tradeweb's trade arranging platform in the normal day-to-day that they would be very accustomed to, arrange the details of the trade, swap the assets after the trade was agreed upon, and the atomic swap of tokenized cash via tokenized treasuries was consummated in literally a split second. The trade lasted for 15 minutes and then was unwound, where the constituents each took their tokenized assets back. They were then, in digital asset parlance, burned, and the traditional assets, which had been locked at the prime brokers and at the centralized clearing organization so that they couldn't be used for anything else while the tokenized versions were in play, were then freed up, and the trade was, finished and concluded, right? So I think what is important for the people here on this call to understand in our thought process, right, a number of benefits came into play. For a trading firm like DRW, it means the ability to use tokenized assets as collateral for tokenized dollar equivalents. This is important because it gets a firm like us into a trade quicker. We can use the cash to get into something on a Saturday. It might lower our return thresholds, but it basically provides a lot more optionality and capital efficiency. I think for a prime broker, the ability to tokenize assets can sort of give them the ability to push out financing, right? So if a customer says, "Hey, I'm interested in getting some financing, what can I do in the world of investments?" Now we're talking about using tokenized assets to get them that financing in minutes. So there's a number of use cases, but as David and as Stephen sort of mentioned at the beginning, what we're really talking about is collateral mobility, right? As people at Kelly's firm, Digital Asset, like to say, and I think I'm a big buyer of this saying as well, we're not necessarily trying to revolutionize finance, right? But what we are trying to do is make the wheels go a lot faster, spin a lot better, and in a cheaper way and more efficient way, right? So we think that this enhanced collateral mobility through the use of tokenization also leads to balance sheet efficiency. And the last thing I'll say, which really, as a 30-year veteran of finance at this point, for me, the magic was almost less about the tokenization aspect, but using an existing fintech platform such as Tradeweb, right, which has hundreds, if not thousands of customers, like many others, in sort of the normal day-to-day, right? We're not talking about new technology that no one has access to or has to, learn or figure out. Tradeweb and other firms like it bring this technology, having integrated into the blockchain, right? And make it very, very simple and easy to use using essentially the same front end. So for us, the future looks really bright because we're not talking about new adoption of new technology. We're talking about existing technology that has been improved upon to take advantage of what the blockchain has to offer. Let me just stop there.
Yeah, it's a great summary, of the kind of settling in minutes, unwinding in hours, and happening over the weekend. Perfect segue to Chris, Glenn's comments about, what is the role of Tradeweb and firms like Tradeweb in supporting these transactions? Chris, over to you.
Yeah, no, thanks for the great tee up, Glenn. And we were super excited to be involved and see the platform in action to do the first trade, and excited to see many more coming down the pike here. And yeah, so we're talking about very significant change coming for so many of the services around how people trade and how people move collateral. I think Tradeweb hopes our role is for some really key aspects of it. You don't have to have much change, and that we can expose these services just like plugging new apps into your iPhone, right? That you don't really have to worry about a lot of the things with what's a wallet and what's the address and will it get there, and or will I lose something in flight? So a lot of these things you might think about in the crypto native world, we don't want the institutional client base to have to worry about that. And so, that makes our job actually fairly straightforward in terms of what we did with this trade in some sense, in that, we can have all the clients that are currently onboarded to the platform potentially pick up this new workflow and use case, being able to get a tokenized treasury repoed for a stablecoin, which didn't exist before, and to be able to do that on a weekend. But in terms of how they think about doing that, it's really no different than logging into Tradeweb, coming to the platform, and being able to execute a repo trade. Tradeweb, we hope we're known for our liquidity pools and the liquidity we provide clients. And that will be paramount, I think, as you see more and more tokenized repo trading, but also tokenized treasury trading, other digital asset trading that may be natively issued digitally. So we know that in the medium term, liquidity is really what will hopefully matter and what will accelerate in bringing the client network. But there's a few other things we do that I think accelerate significantly here, that maybe just go a little unsung, but are now coming out to see how important they are. And that's really just how we plug into the whole ecosystem, right? So if you're a motivated participant right now, you're going to figure out how to do this trade, whether it's on chat or on our platform. But as we want to scale that to a whole bunch of the traditional buy side, whether it be hedge funds, real money, pension accounts, insurance accounts, well, they all have very strict processes in terms of how they execute orders. And that's where I think the way that we can plug into all that existing infrastructure, we'll be able to scale what we can do here very quickly. And because it'll just work, hopefully, right? You'll just be used to sending an order from your OMS, and it doesn't really matter which OMS it's from. And so for many of the things we're talking about, the tokenized version of a workflow or a trade is really just the digital rails along the side and in the back end and the pre-trade and the post-trade. So we were really excited to see this occur. And we want to make sure that people sort of see that message that, well, what do I have to do? Well, you don't have to do too much more than you're used to doing today.
Thanks, Chris. That was a great summary. Kelly, over to you. I think, here we know that digital assets supported the participants in these transactions with Canton and the DAML infrastructure. But what do you see from your perspective? What was necessary to make these collateral movements happen on chain and for that collateral actually to be there when people say it's there? Yeah.
Yeah, as I sort of mentioned, my background is capital markets. More specifically, I ran clearing and collateral management for a number of years at JP Morgan. So the transactions that got done, frankly, by the other voices on this panel, as short or just one Saturday so far that they've been done, really quite momentous, because I think to the world of financing and collateral management, margin movement, and the like, it's important to note a few of the key foundational sort of building blocks that were accomplished. But to your point, there are still some that are open and that we and others hope to continue working on. So just to reinforce a little bit of what Chris and Glenn have talked about, it was important first to get access to, as you said in the opening, the high quality liquid assets. I think Stephen mentioned the same thing, gaining access to the high quality liquid assets. So much has been done in this industry, including with our platform, to create digitally native instruments. And I think, honestly, a conversation for another day is when that will sort of overtake what we're talking about now. But in the interim, there's so much, even in the TradFi space, to want to get access to those real world, high quality liquid assets and be able to use them more real time, more immediately in a more 24/7 model. The entirety of the crypto markets and the DeFi markets that are emerging will need more of that. Entities are starting to bounce up against their trading capacity limits by not being able to access more of them or in greater volumes. So there's a large chunk of activity that needs to be done first to get access to those, very plain, normal US Treasuries, Euro govies, gilts and the like, and be able to make them more available around a 24-hour clock. And that was one of the important milestones accomplished in July, and there'll be some subsequent transactions that you'll hear about shortly. But accomplished in July, get that large pool of assets into an ecosystem and into an on-chain form. And that's one of the sort of key four building blocks in my mind, if you will. The other is what TradeWeb accomplished. It's sort of one hand clapping if you just get those assets there and then there's nothing to do with them. So having an actual application that can allow for repo activity and increasingly more and different variations of financing activity is critical. And frankly, it wouldn't have been as nearly an interesting activity if we weren't all able to be talking about what you could do with those on-chain assets. So having those applications that then contemplate being available and being able to provide variations of, as sort of Glenn was sort of saying, very BAU traditional types of activities, but making them available outside of the traditional market operating hours, as TradeHub has done, giving something for those assets to be used. That was sort of the second thing. The third thing was cash, which was also accomplished. Another one-hand clapping analogy would be if the security side of a financing transaction were able to move with atomicity and immediacy, but the cash is just moving in a fiat 3 days to clear in the United States and elsewhere around the world, you wouldn't have accomplished much. We would have, talked about, we wouldn't have accomplished a repo, to be honest with you. So having the on-chain version of cash, as Glenn mentioned, done with Circle. In July, you'll hear about another couple of stable coins doing some transactions over the course of the next few weeks, but getting that so that you can have atomicity across the full financing transaction. And even if it were, as time goes on, to become more complicated versions of repo or even securities lending type transactions, you still have the cash activity. So getting that cash on chain. So kind of leaves what's next, or what's left, which is sort of the point of the question that you've been saying. Well, it's still missing having a collateral management functionality. It is the transactions that have been done with organizations that are incredibly sophisticated, able to support excuse me, a certain amount of bilateral activity. But very quickly, the volume of that activity as we roll into next year is going to go beyond what anyone will want to do as sort of bilateral transactions that we're just sort of tracking one by one. And so so I say this to organizations, the fourth leg of the table is to get collateral management functionality into Canton Network and into this on-chain ecosystem. That can be collateral coordination and the ability to move collateral seamlessly across different locations like custodians or CSDs and the like. It could be coordination in between different entities that are going to use it as margins, say across different CCPs. It could go a level higher to more active collateral management, where it's introducing decision making on behalf of the entities that have the collateral deliver or receive obligations, and figuring out how to time which pieces of collateral from an eligibility criteria and sophisticated allocation. And frankly, it can even go above that into risk management and optimization as you kind of go along the continuum of collateral. All of these are still areas that need some real time and attention in the ecosystem. And probably wouldn't surprise you that we're having conversations with many organizations to do that, to add on to it. But that's what makes that foundation able to support increased volume and activity across TradFi, just the simple ability to use a US Treasury to meet a TradFi regular market obligation, say out in Asia, but not having to pre-position or pre-fund that collateral, and being able to support the ability to call that collateral at will in a 24/7 model, as increasingly some of these markets go 24/5 or 24/7, and meet the demand of emerging crypto markets. Still much to grow on sort of the three legs of the stool, the real world assets, the ability to be able to do something with them in cash. And that fourth leg of the table is where there's material opportunity, to your question exactly.
Thanks, Kelly. You mentioned the importance of having a system for trading for order entry and management there. I think sort of takes us back to Chris and Tradeweb. And I wonder if, Chris, if you can speak to anything specific you had to do to operationalize your platform for this, more 24/7 world. What did you have to do to make sure you were ready?
Great question. And it's the beginning of, I think, a really substantial, important journey for us. The first thing we had to do was really deploy 24/7 trading capabilities. And so we try not to think about that as let's do that just for tokenized repo trading. We actually instead made a whole new instance of our platform, UI and backend, that's cloud deployed, such that we can now start thinking about trading any asset or any digital asset, repo trading, on the new 24/7 capabilities. But that's probably the biggest first step. And our tech team did an amazing job doing this in a very short time frame in recent months. We have taken that choice for the near term, that it really is a separate instance of the trading system, because it allows you to insulate new and old for a while, right? So let's do new things here. But from the client's perspective, it looks literally exactly the same, except we had to upgrade the repo ticket to have an intraday fee field, and start to do the calculations on a minutely basis, right? So, but that we're used to that. That's exactly the type of incremental improvements that we customize by market and by market structure with every asset class we offer on the platform. But there was a big step change in terms of a new instance supporting 24/7 capabilities, and then being able to add on different workflows and use cases and products as we go. And the not distant future, we're going to be figuring out how to support those systems, right? So these are production use cases that we expect to scale pretty quickly into next year. And so how many staff do we need remote working, or at least available on a weekend? We hope to keep it pretty minimal, but there's a lot that goes into a lot of other firms that are ahead of us in those respects. So we hope there's lessons. But this message for us, and it was exciting to see even though it was bilateral, it was an electronic trade. It was on an electronic ticket. And so I do feel like there, for us anyway, is something important around, if you're going to go to digital rails, you might as well go straight to e-trading as well, where you can, because you get all of this order trail, audit trail, process, regulatory environment. You get a whole bunch of things for free, jumping straight to e-trading on the platform. And it kind of feels right if you're talking about more instant settlement, more instant mobility. So those are some of the things we had to do from the trading platform side. I think the other big piece is really our connection into the Canton network. So, and that is another thing that will be evolving step by step through time. And so in the near term, that looks a lot like kind of a dual reporting almost, right? So when you complete a trade, you're going to update the Canton network. We'll expect to see that clients are adding nodes, so they could probably listen to the Canton network itself through time for a greater array of the types of state changes that could happen for certain activities, like executing your repo trade. Hopefully in the future, that's rolling your repo trade, right? And doing other things. From our side, that dual reporting piece will happen for a while, because we're going to have literally hundreds or thousands of clients that are still going to need to have drop copies of their trade reports, back to their OMS. But that's okay. That really isn't a lot of overhead. And then we hope that offers the community on both the liquidity provider and the client side the ability to kind of keep doing what they're doing today, But then as new functionality sort of offers the, abilities to do things they couldn't do before on the blockchain, then they'll be moving over to the blockchain in a fairly natural manner, right? And not having to pay a big upfront migration cost per se, just because to participate, you have to be linked in a new way. You can be linked in the old way to start.
Thanks, Chris. You mentioned connecting into Canton, and maybe I'll pause and kind of ask the obvious question here. So this all sounds great, right? But what about what were some of the challenges here? What were some of the issues? Maybe, a number of different trading firms, Glenn, or the need to onboard. What were some of the challenges that took place, sort of getting everyone working here together on this?
Well, I think like anything, you have to make a commitment, right? There has to be a mindset through the organization to say, look, we've done the analysis, we've done some research, we've had the conversations, and this is something that is going to make sense to our firm, right? In a meaningful way. Otherwise, there's very little point in doing that in the first place. So, in that you have a process of weeks, maybe months of understanding what the market opportunity is, understanding what the balance sheet considerations are, and really just trying to figure out if I were to get to a final state of this project using blockchain technology, for example, is this going to make a meaningful difference to our organization? And obviously, our firm, uh, we believe that is the case, right? So the interesting part is that, we get to this Saturday and the trade is arranged in a matter of minutes. It settles in literally, it's executed and settled in probably subatomic seconds. And it's put on the platform. The duration is maybe 15 minutes. It's unwound, and everyone says, okay, great. You know, that's wonderful. Now we can get back to our weekends, right? But there are points of friction, and a lot of them come from the legacy processes. So, for example, you mentioned onboarding. As we understand participants, whether it is from the trading firm side, whether it's from the prime brokers, whether it is from, other participants, we need to make sure we can onboard, right? And sometimes that just takes weeks, if not months, depending on the process that each firm has, right? Everyone's got risk and compliance departments. Everyone has other people that are very responsible for making the decision to safely enter a relationship with a counterparty to make sure that the transactions are authorized and that they fall within a certain regulatory comfort level, right? Um, to this point, I don't believe that anyone has really created a product to ease that process. I think people will over time, but there are certain parts of this procedure that are just coming up as points of friction, not necessarily in a bad way, because this needs to be done, and everyone on this panel and everyone participating in these trades wants to be fully regulatory compliant, right? But I think we've made the strides in terms of efficiency on the trading side, the trade arrangement side, the settlement side, the swap side. Now we need to basically think about how do we get comfort in a way that makes the onboarding process and things like that much simpler and more efficient.
Thanks, Glenn, for that kind of honest assessment of some of the difficulties and challenges. And I'd like to get back to Kelly. Perhaps we can talk a little bit about the importance of DTCC here.
Sure.
You mentioned, we've talked about DTCC enabled the creation of these on-chain U.S. Treasuries. How how important is that role and of DTCC here, and how does it increase some of the? I mean, Glenn mentioned some of the trust and the infrastructure that's needed. How does that DTCC actually help us out here?
Yeah, no, I'm glad you asked the question, and I'm delighted to be able to share it on their behalf. Actually, I think it goes to a couple of the questions that the audience members asked, so it's really quite good. One important thing to say here is, and we probably won't do justice to it in the time, but we are, I mean, some of us are casually using the word tokenize just because that's the word that gets used in the industry when you take sort of a real world asset and create the on-chain form. But if you notice, I keep using the word on-chain, and Glenn and Chris are going to smile because I keep pressing this point. A token makes it sound like it's a different asset. Sometimes they're wrapped assets, or they are digital twins of an asset. I've even had people ask us post the July trades, what was the CUSIP for the thing that you created? But I do think that much of the effort in this industry so far has been focused on sort of wrapping the assets such that, say for example, in the model that we did, the token would have been issued by the prime broker or something, and then it makes it not fungible because then if Glenn and I are at two different prime brokers, do I have to burn it at my prime broker and then issue it over again as his prime broker? And it also introduces a level of risk of, if you're wrapping it or if you have a trust certificate over some custodian that's holding it, well, it means that the ledger is not recording you as actually owning it. They're recording that an entity has wrapped it or issued it or whatever. That is not what we did. And if for anybody who wants to have a deeper conversation on this after today, delighted to do so. But that is not what we did. The reason we used the term on-chain assets is because there was a very intentional structure created with DTCC, and they can tell their story in the coming weeks about how their strategy for that. But what we did in these transactions is the actual real world asset, the US Treasury, was immobilized at DTCC. I'm going to say made dormant, pick your favorite word for it, but it was, and it just used the regular old form SEG and pledge accounts. So no new account structure at DTCC, something that is only open to the members at the moment, but no new account structure. And so it immobilized the real world asset at DTCC in the account, made it dormant, means it was not able to be used for anything else, such that the on-chain version of the asset that is being created is the only version of the US Treasury that now exists. It's not a wrapper, it's not a claim on DTCC, it's not like a code check where you show up at DTCC, your prime broker. It is the US Treasury. And that is what enables it to move fungibly around inside the Canton network. And it does not introduce a new risk or a new level of there's nothing about it that doesn't show that if Glenn is the one that traded that US Treasury, it showed, the ledger showed that Glenn was the owner of that through his prime broker. And one of the questions that got asked is, shouldn't the ledger, and Dick, hello, it's nice to see a name from the past come up. One of the questions that got asked by one of the audience members is, shouldn't the ledger record all sides of the transaction? Yes, absolutely should, which is why it did. And so in our transactions that we're talking about here, the Canton ledger was used by DTCC to record the creation of the on-chain, the request to create the on-chain version, the allocation of that on-chain version, the prime brokers ledgers were the Canton ledger to record which of their underlying clients were using that and having the record of it. And then as Chris has alluded to, the Canton ledger was used by Tradeweb to record all aspects of the repo. The request to mint, as Glenn had referred to, mint the USDC from US dollars at Circle was on the Canton ledger. So all of this is on the Canton ledger, which enabled it to serve as the single source of truth for all of those entities.
Thank you, Kelly. Appreciate you addressing some of those questions that have been coming in live. So please go ahead and add your questions to the chat. This is a great time to sort of even pause and reflect on what we've heard, and actually to launch our poll question, which should now be available to you. And one of the things we are most interested here from all of you is what you think are some of the most important benefits when utilizing collateral management on chain. What do you think are the most important benefits? So please go ahead and submit your responses. Also, just note that if you scroll down, there's a number of potential answers, so make sure you scroll all the way to the bottom. Kelly, you mentioned, on-chain. I'm glad we included that language here because that is a key distinction between these digital twins versus actual natively on-chain assets. So as these questions or responses are coming in, I will just give you a sort of a 10-second warning, and I'll count us down. And then one of the great opportunities here will be to get reflections from the panelists. So I'm going to give you 5 more seconds. We're at a pretty good participation rate, right at almost over a third of people. Maybe we can get up to half if I wait even a few more seconds. Okay, get those responses in. I'm going to count us down. 5, 4, 3, 2, Looks like we're paused right there. So I'm going to go ahead and close the poll now, and then we'll see the results. So, okay, everyone, let me share the results back to all of you. So this consider this an open question. Everyone in the panel here, the number one benefit here at the top is enhanced collateral mobility across jurisdictions and time zones. So, very much speaking to the 24/7 nature of the assets. Increased balance sheet efficiency is looks like number three, because I see 41% at faster speed. So speed and collateral mobility seem to be the key themes. Very interesting. Hey, Chris, what do you think about this? And then we'll go to Glenn. Anything jump out at you?
It's really exciting to see that there is such a dispersion, meaning there's not just one benefit here, right? That, a variety of different people are, sort of keying in on, all these different benefits, and there wasn't just one or two. So I think that's really interesting to see. I
Yeah.
think when you look at collateral mobility across jurisdictions, that syncs with, our worldview as well, right? This is a global business that we're talking about here, multi-currency, multi-domain. And so that's, a lot of this goes to like cost, the benefit of cost, meaning I don't have to pay for full days and I can, have optimization across time zones and intraday. Those seem, and that I think goes to the speed question here as well.
Yeah.
So that makes sense to me, because when we're talking as many trillions of collateral in scope, if you can move it quicker and just pay for what you need from a risk perspective intraday, you're talking, hundreds of millions, billions of dollars of annual savings potentially, as well as operational robustness and just knowing the capital is where it needs to be, when it needs to be, at which venue. So I think these are really encouraging results, but maybe I'll let the other panelists sort of speak to some of the other benefits here.
Sure, go ahead, Glenn.
Okay, just to jump in, thank you, David. I agree with everything that Chris said. I think it's really, really great to see the sort of the dispersion among the responses, right? And I think that this is really important. I think there's a couple of things that we can build upon. First, I hope this shows the audience and the people on this webinar, right, that there is many, many uses, right? And someone might say, okay, well, I think increased balance sheet efficiency is the thing that resonates with me the most or for my firm, right? Or someone says, okay, well, 24/7 trading or capital movements is much more important to me. As a trading firm, right, I think DRW is interested in all of this, and I would have probably scrolled to the bottom just to find out to see if there was something like all of the above. But that doesn't matter, because I think the real benefit is that people can look and see what is most important to them. If we have people, say, that work at a multinational, possibly doing the job of a CFO or a treasurer, for example, being able to shift capital to subsidiaries and divisions in different countries, different time zones, literally in minutes, as opposed to making sure that something sent out by wire, for example, doesn't take 2 or 3 days. You hope it gets there. You hope that if you have a report that's due to a regulator or, a governmental authority that shows, the proper capitalization needed, you have less worries, right? There are obvious risk mitigation benefits to being able to send capital all over the world, irrespective of time zone or region. With that, I think naturally comes balance sheet efficiency, right? People can make informed decisions based on the fact that if the need to account for time and speed is minimized, right? That gives people who have to make decisions much more flexibility in how they can allocate capital, how they can push out, trades or cash or collateral for whatever needs they need. Faster speed of internal and external transfers. I think that builds on the same narrative. It's just the ability to get things out the door quicker or bring them in a much more expedient fashion. So I don't think we need to go on. I think it's really great that everyone had a wide-ranging view of what they felt was most important. I also think that this might also indicate, outside of all of the above being at the bottom of the poll, that we need to do a little more education. We need to continue thinking about the narrative, because our hope is that people will take advantage of multiple things, because it all comes from the same source, which is enhanced collateral and capital mobility. And people can pick and choose what is best for them. But hopefully the message is that there are possibly multiple things that could be attractive to their firms and to their entities.
No, I think that's a great summary, Glenn. This sort of speaks to the future state, and I think I want to go back, and we're already getting some great questions in, so we'll do our best to address some of those momentarily. But the question comes to mind here, Kelly, is what other assets we might see tokenized in the near future.
Yeah.
That's one thing. And the other is just kind of going back, Chris, just you can answer secondarily is the cross jurisdictions and time zones. You already talked about the 24/7 nature of trading and having staff in different jurisdictions. Does this increase your commitment to having, Saturday hours and folks navigating different time zones? So, but Kelly, first, what else should we see here?
Sure. I alluded to the importance of wanting to chip away at these real world high quality liquid assets. But just to use the stat, it's it's something that the SIFMA publishes every July. There's about 270 trillion of these high quality liquid assets around the globe. And for all the years, there's been many, but for all the years that I've been in clearing or collateral, the statistic has remained about the same, even though the absolute numbers have changed. Only about 10 or 11% is actually in use. So I think there's a good question in it about whether or not this is going to shift to creating digitally native instruments, and I hope it does, and I actually think that that's the direction of travel. But for right now, there is a 90% market of high quality liquid assets that are in demand that are not being used, and so or not being able to get access to because of settlement times and cutoffs and market restrictions and all that kind of good stuff that on-chain can help break through. Beyond U.S. Treasuries, it's all of the other instruments of that 270, 100 trillion are sitting in the U.S. across equities and munis and corporate bonds. But there's also others that I've mentioned: UK gilts, Euro govies, JGBs, bunds. These are the chunky assets around the globe that are probably easiest to get at from an on-chain perspective, easiest to lock down, and yet are those that are in the highest demand and will feed that mobility and liquidity that Glenn's talking about. So I would say watch the space. There might be some information that comes out into the market soon. I personally would love to see U.S. equities get tackled. I think that will be a bit of a game changer for the industry.
Chris.
Yeah, I think that's a good summary, Kelly. And I think we're starting from a pretty good place in that it is global, and we have a 23x5 platform, and we've actually had that for many years, decades, right? So we're not starting from square one, and I think that's important. This is going to have to be global to make those incremental steps to 24x5 and 24x7. I think a few themes. I think the pace of change is going to be very rapid. I think people might be surprised. Maybe they're not surprised anymore. I don't think we are, to a large degree, because of the rise of AI, just because of the distribution of these new technologies happening so quickly. But I do feel like people need to think about that for each of their own firms, because we used to be thresholded by other things, whether it be the regulatory pace of change, just how long it takes to get consortiums doing a bunch of anything. I don't really see a lot stopping the pace at which this can move from here. And part of that is another one of the themes is there's a really cool sort of interplay between the DeFi world and crypto, right? This 24x7 repo trade was for crypto liquidity providers. And so a lot of these firms, as well as a lot of the firms already in our network, are super progressive and fast moving. And so I think that there's a serious appetite. And so a lot of this is self-generated. It's not really coming just from some external pressure like, Dodd-Frank may have been in the past, right? So I do think the pace of change people really need to think about in this new generation of AI. It goes back to the nice question that Stephen asked before. AI is actually what's on the top of people's minds. For me, it's actually more than AI. It's just that the pace of change is incredibly rapid right now. And then the final thing for me, going back to which assets, I do think there's significant acceleration of use case expansion here. And that's clearly what I think all of us have in mind. We know this is 24/7 tokenized repo for a stablecoin, but there's going to be more stablecoins on the cash leg side. There's probably places where you're going to want a tokenized bank deposit, right? There could be other forms of payment systems, legacy and new, coming in on the cash leg. And then there's a whole variety of things coming in on the asset leg. And so you start to then think about, well, it's not just the, repo trade, it's going to be collateral, at clearinghouses and exchanges. It's going to be hopefully changing how the derivatives market changes from an IM VM perspective. What are the instruments that we're going to be moving around? So I do feel like there's acceleration on multiple fronts coming to bear here. So it should be fun.
A really great summary. Yeah, I mean, if you're looking for a pace of change, anecdote as well is just simply the fact that the CFTC and the SEC are now having these joint sessions and collaborating. It just seems like there's a lot of momentum around harmonization and supporting innovation, to be frank. Okay, Glenn, while you're answering sort of the next what's next for Canton, I'm going to start reviewing the questions and then we'll jump into questions. But Glenn, why don't you close that out?
Sure. Thank you, David. I think along with the partners we have here on the webinar, obviously Chris from TradeWeb, Kelly from DA, and others, our goal really is to expand the ecosystem, right? The so-called quote unquote final state is really just to make this business as usual and to integrate everything that we're talking about into sort of the daily workflow. So I think the group that is participating will be expanding. I think, there are a lot of people, as Kelly liked to say, we're all equals. We all sort of want to do this of our own accord. And we are going to be thoughtful and methodical about how we do this. So what does that mean for the next trade or set of trades, right? We are introducing more counterparties. We obviously would like to have more participants, whether trading firm or otherwise. I believe that the number of prime brokers will expand as well. And then we think about, as Kelly mentioned earlier in the call, uh, tokenizing gilts in the UK versus possibly a GBP or a British pound stablecoin, doing the same thing with Euro govies versus a Euro denominated stablecoin, or possibly incorporating even an FX transaction that might be a swap between, say, gilts or Euro bonds and US Treasuries, right? One other thing we might consider is basically, a lot of the initial trades, we are minting the tokenized asset, swapping the assets to do the trade, and then burning them to restore the real world asset to its original state, so to speak. We may do a couple of secondary transactions so that when things are in tokenized form, right, what we're basically saying is in the future, not too distant, but a little bit in the future, we expect things to stay in tokenized form, right? So as Kelly mentioned, if you tokenize a treasury, that is your treasury, whether it's in tokenized form or real world asset form. And given the benefits of using blockchain technology in terms of the speed, the efficiency, and the cost benefits, right, we expect many of these asset pools to simply stay in tokenized form. They will be used by corporate treasuries. They will be used by prime brokers, excuse me, and other financial institutions just in the normal course of business. So what we're trying to do in October is expand the universe of participants, expand the sort of types of trades, and also expand the jurisdictions within the trades occur.
Great summary. I think if I look through the questions, and by the way, we've had great participation throughout. A very high number of people have stuck through when we've gone over 45 minutes. It's fantastic. If I could organize the questions into two categories, one would be what what institutions need to do to get ready. That's sort of question one. But I think the bigger question is what are some of the risks? Question two is really around as on-chain settlement scales, what are some of the potential risks, as well as what some of the risk requirements that institutions need to address to use these on-chain assets at scale. So I'm going to go back to Kelly, I think, on just as this scaling happens, what are some of the potential issues or challenges and what needs to be done?
Yeah, just given time, I'll say sort of three things and just plant the thought for more conversation at another time. I mean, coming from the technology provider, I'm going to say first and foremost to make sure that the layer one Canton is obviously what we're talking about here today is able to scale from a technological perspective. I can't tell you the amount of effort that we put into that. We take it very seriously. At Digital Asset, we get to work with good partners like DRW Cumberland and TradeWeb and others that are in this working group and others across our business. So, but number one, you have to be able to make sure that, like no joke, if you're talking about handling capital markets activity, it has to be something that is way the heck beyond a POC or a pilot. and can be able to handle the scale and the throughput requirements that would be necessary, especially if you're going to make those throughput requirements now supporting real-time transactions. But I am going to say two other things. One is Glenn had touched on it. I cannot tell you, having lived through this for so many years, I've been a DA for almost a decade now, the number one thing that actually takes time is having the contractual relationships between the entities. And you think that the capital markets is so advanced at this point, who could possibly not be interacting with who? But you still need those. And having those either repo agreements or securities lending agreements or prime broker agreements or custody agreements or agreements to onboard with Tradeweb, these are real documents that need to get done, and no amount of technology is going to change that. That's the thing that has actually taken the most time. The third thing I would say is, like any technology project where you're adding a new technology in, if you have internal controls and regulatory reporting, you have to contemplate getting the data out from that to be able to fit into those reports. And there's necessarily going to be a transition time where you're probably doing it off of multiple systems. But frankly, every technology project I've ever been part of has had to do that. But it's just an important one to mention.
Great. Thanks for taking that on. And I will leave Chris with the last word. I think the comments have been around just generally being ready. Kelly mentioned getting your documentation done. What are the things do institutions need to do to be ready for this new world? And then we'll close out after that.
Yeah, for sure. I think, from our perspective, we would say try to take as many things off the table to make and it does take time. So, if it's engaging with us, if it's learning about the technology, if it's contemplating what infrastructure changes your organization needs, do I need to run nodes to access these functionalities? Can other people host nodes for me? Those are the nuts and bolts practical types of things. I think within the assets and trading themselves, how are you going to trade the cash leg and how are you going to trade the asset leg at your firm? And are these things digital assets, right? So far, some of what we've talked about, you don't really have to worry about the treasury because it's still with your prime broker and it's in existing form. In the future, you may need a custodian who's custodying digital assets as well as traditional assets. You may need that if you're going to be involved in stablecoins already, right, as a cash leg. So I do think sort of identifying each piece for your firm, what's already there, what do I need to take on next, and planning that out. Because again, I'll come back to the pace of change. I think things are going to move pretty quickly from here. So, preparing is paramount. We hope to be showing people the benefits of all these workflows in very short order. So pretty quickly, it'll hopefully drag you in.
Getting prepared is the key. I think, as you mentioned, that the world's speeding up. We certainly noticed that in terms of our research that Stephen showed around AI and tokenization, and appreciate everyone's participation here. It's a fantastic panel. Thank you, Kelly, Glenn. Thank you, Chris and Stephen. Wonderful conversation. I think we just need to have more of these. But thanks everyone for listening in. Take care.
Thank you.
Thanks, guys.
Thank you. Bye.
Bye-bye.